Hello, 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 hello. So welcome to our next chapter, that is your PGBP, and we are covering this in our next video of 1350 pages. So PGBP, we will start a little. This will be a lengthy video of about 30 minutes. I will make a separate video for the adjustment. So let's start with our PGBP. So first is start with section 32.1.2, that talks about your depreciation. So under depreciation, they have maintain that there are basically four classes of assets. So there are four classes of assets. That is, first is your building, second is your furniture, third is machinery, and fourth is your intangible assets. So there are four types of assets. First is your building. Under building also they have bifurcated into three types. One is if it is your residential building. Next is if it is for non-residential building, and third is your temporary erection. So residential building is your societies, etc. All of these come under residential buildings. So on those, there will be a depreciation of 5%. 5% depreciation will be allowed. For non-residential building, it will be double. That means that is used for commercial purpose. So instead of 5%, the rate will become 10%. Then you have your temporary erection. Say for example, a building is being made, but the worker that are making the building, you have made some temporary housing for them. So in such a case, for these people, the temporary erection that you make, that will be taxed at that will be depreciated at the rate of 40%. Okay, now next is your furniture. Now furniture, there is only one rate, easy rate, that is of 10%. So furniture and fixtures will be depreciated at the rate of 10%. Next is your machinery, a little complicated, but I've made it as simple as possible. So under machinery, first is your motor vehicle. So under motor vehicle, if you acquired and put to use, if both of these things were done, that means you acquired, you purchased it, and you put to use between the date 23rd August 2019, between the date 23rd August 2019 to 31st March 2020. In such a case, depreciation will be allowed at the rate of 30%. So 30% depreciation will be allowed if it was acquired and put to use between this date. Otherwise, your depreciation on motor vehicles is 15%. If this motor vehicle was being used for the business of hiring, if it is used for hiring business, then 15% additional depreciation will be given. That means this 30% will become 45%, and this 15% will become 30%, only and only if it is used for hiring business. Any other plant and machinery, that includes your mobile, EPABX, all of this. So I've included this because they separately mention this in questions. So you have to remember that this comes under machinery. So this is taxed at the rate of 15%. Your ships and vessels are depreciated at the rate of 20%. Sorry, your other plant and machines also depreciated at the rate of 15%. Next is your computer software, printer, scanner, books, aeroplanes, windmills, pollution control equipment. All of this is depreciated at your maximum rate of 40%. This is the maximum depreciation allowed. And last is your intangible assets. So under intangible assets, your know-how, patent, copyrights, trademark, franchises, etc. All of this comes, not goodwill. Goodwill does not depreciate anymore. This was earlier. Therefore, I have written goodwill and cut it because goodwill is no longer depreciated. So all of this will be depreciated at the rate of 25%. So we'll quickly remember the rate. So for residential building it is 5%. For non-residential building, the rate becomes 5. The rate becomes double, that is 10%. So 5 into 2, that is 10%. Next is your any temporary erections. Temporary erections are depreciated at the rate of 40%. Now this was your building. Under furniture and fixed fittings, we remember that there is only one depreciation rate, that is of 10%. Then we did your machinery. Under machinery, we did motor vehicle. If it is purchased and put to use between that date, then 30%. Otherwise, it is 15%. If it is used for the purpose of hiring, then additional 15% will be given. All other machinery will be depreciated at the rate of 15%. Your ships and vessels will be depreciated at the rate of 20%, and all other your computer software, printer, scanner, aeroplane, windmill, etc., all of that will be depreciated at the maximum rate of 40%. So that depreciation is 40%. And last is your intangible asset. Your intangible asset is depreciated at the rate of 25%. So these are all your depreciation rates. Now there are certain depreciation rules that you have to remember. So first is depreciation will be claimed when the asset is put to use, not from when the asset is ready to use, not from when the asset is acquired, but when the asset is put to use. Next is your depreciation is claimed by the beneficial owner. That means, so there are two, at times asset may be purchased by someone but being used by someone else. Say for example, it has been rented out. In such a case, the depreciation is claimed by the beneficial owner. That means who is deriving benefits from that asset, that is the person who will claim depreciation. Next is depreciation is on WDV basis. That means it is on written down value basis. It is not on SLM basis. It is on WDV basis. However, certain businesses have been given an option. Which businesses, sir? That is your power generation and your power distributor. These two types of businesses have been given an option to choose SLM. That means they can choose individual asset method and straight line method, or they can go with the WDV. That is, they have given an option that, sir, you can choose either of these. Next is lesser claims depreciation in case of a leased asset. That means the person who is using the asset, that is the lesser, he will be claiming the depreciation. Next, asset to be added to block even if it is not put to use. So these four types of blocks that we have studied, your asset will still have to be added to the block. Depreciation will not be given, but the asset will be added to the block even if it is not put to use. WDV of block can never be negative. WDV of a block can never be negative. Now, why do I say this? We will study when we do the short-term capital and short-term capital loss. I will explain why WDV cannot be negative. It can minimum be zero, but it will never be negative. Next is half rate if put to use on or after 4th October. Please remember this date. It becomes very easy. If if the asset is put to use, if the asset is put to use after or on 4th October, in that case, all these rates that we have mentioned, all these rates that we have mentioned in the table, these will become half. If it is purchased in the same year and also it is put to use after 4th October. Now say for example, if this asset was purchased previous year and put to use this year after 4th October, in such a case, full depreciation will still be allowed. Only if the asset is purchased in this year and put to use after 4th October, then half depreciation. If the asset is purchased this year, put to use before 4th October, full depreciation. If the asset is purchased in the previous year, put to use after 4th October, you will still get full depreciation. Only and only if the asset is acquired in the same year and put to use on or after 4th October will half depreciation be allowed. Next, new plant and machinery other than transport vehicle, any new plant and machinery other than transport vehicle, if it is acquired and installed but not in the office, if it is acquired and installed by a goods manufacturer or electricity generator or distributor, you will get an additional 20% depreciation. Next, if amalgamation or demerger, apportion depreciation based on the number of days used by both the entities. In such a case, what do? You assume as if there was no amalgamation, there was no demerger, and you calculate what would have been the depreciation. Now you have a figure. Now you have to apportion this figure based on the number of days that the asset has been used by either of these entities, and then you have to distribute it. Next part comes your short-term capital gain, short-term capital loss. Okay. Now, in case of assets, in case of depreciation, in case of sale, there will always either be a short-term capital gain or a short-term capital loss. You have to remember there will never be a long-term capital gain or long-term capital loss. Okay. So say for example, you have five assets in your block. You have five assets in your block and their WDV is say rupees 100. And you sold five assets say for rupees 70. In such a case, since your number of assets in the block is now 0, and instead of 100 you sold them for 70, so there is a short-term capital loss of 30. Okay, this is because the number of assets has reduced to 0. Now we will do another example where which will be a short-term capital gain. Say for example, you have five assets in your class whose WDV is 100. You sold three of them for 125. In such a case, what we usually do, we do 100 minus 125. That is 100 minus WDV minus your sale price. But if your sale price is more than WDV, this will go to negative 25, which as we studied, this is not allowed. So therefore, your block's value will become 0. Even though there are assets, the block's value will become 0. and this 25 will become your short-term capital gain, that is your STCG. Okay, so this is your short-term capital gain and short-term capital loss. Next is if goodwill is already in block, that means earlier goodwill was allowed. So if goodwill was already in block, subtract your cost of acquisition minus notional depreciation from the block. That means what has already been allowed. You already remove that has what is left of the goodwill. You subtract that from the block so that your block is now goodwill free. Okay, so this was everything with regards to depreciation. Now coming to our other section. So these sections you have to study together, that is section 33AB and section 33ABA. 33AB talks about growing tea, coffee, rubber. Tea, coffee, rubber is 33AB, and 33ABA is your producing petrol or natural gas. So producing petrol or natural gas. So what income tax says that we will give you a deduction if you give certain money in certain type of fund, and this fund also we will allow you to use later. But if you deposit a certain sum of money, we will give you a deduction. So deposit first you have to remember is when do you have to deposit? That is earlier of within 6 months from end of previous year. Earlier of 6 months from end of previous year or due date of ROI, whichever is earlier for 33AB. While for 33ABA, it is end of previous year. Deduction amount. What will be the amount of deduction allowed? That means actual amount that you have deposited or 40% of PGBP, whichever is lower. Actual amount you have deposited or 40% of PGBP, whichever is lower. And for 33ABA, it is the same limit, just instead of 40%, it is 20% over here, whichever is lower. Which account do you have to deposit it? You have to deposit it in the NABARD account, and over here you have to deposit it in the site restoration fund. Why? Because when you produce petrol, when you produce natural gas, you dig the earth and then you leave the land. So government want that you transfer these funds to a site restoration fund, so that when you are done mining the land, you leave the land as it is. You spend some money to make the land as it is. That is how you had received it. So therefore they make you deposit in the site restoration fund. Now utilization of this money that you have deposited, it is not allowed in office. It has to be used within the same year when withdrawn. Whichever year you withdraw it, you have to use it within the same year. And if you have used this money to purchase any asset, then such asset cannot be sold within 8 years from the end of the previous year. This money, if you've used to purchase an asset, this asset cannot be sold within 8 years. You are only allowed to sell it after 8 years from the end of previous year. Next is your section 33 ABB, that is lease to operate telecom services or spectrum. So if you notice 33, 35 ABB. So under this, there is a huge amount paid. Say for example, for spectrum license, you have to pay crores of rupees. So in such a case, income tax allows your deduction over a period of years. That is, it is to be amortized from the previous year in which license fee paid till the previous year in which it expires. So from the year in which license fee is paid till the previous year license fee expires. So what you have to remember is, say for example, if you paid it in June 2024, now this will expire in June 2025. So this is, say for example, June 2024, and say for example, this is a 10-year lease. So it will expire in June 2034. Now the period is 10 years, but number of previous years if you calculate will be 11. So in such a case, therefore it is an example that license fee may be for 10 years, but it has to be spread over 11 years in such a case, because there are 11 previous years, 11 financial years coming in this period. So let's say, just for example, we are calculating something. So if the original cost, if we purchase these license for 100 rupees, if we purchase it for 100 rupees and we depreciated it for 2 years, we used it for 2 years, and now the WDV comes to 80. Okay. So this was 100, we used it for 2 years, and now the WDV is 80. And we sold it for 150. That means 50 rupees over 100. We sold it for 150. So in such a case, this profit of 70, this 80 minus 150, that is your 70. This 70 will be bifurcated into two, that is your PGBP and your capital gain. So anything over the cost price will become your capital gain. So this 50 therefore becomes your capital gain, and the balance 20 becomes your PGBP. Now to determine whether this profit, whether this is short term or whether this is long term, that depends upon the period of holding. So over here also the period of holding will be 36 months to calculate whether it is short term or long term, as we studied this in capital gain. Next is how to determine your cost of asset. So for cost of asset, if the asset is used for scientific research, if the asset was used in scientific research, but it is now being used in regular business, if it was used for scientific research, but it is now being used in regular business. So if you remember under scientific research, we give you 100% deduction. We give you 100% deduction under scientific research. That means entire benefit has been given. So for depreciation, we will not be giving you anything. Therefore, your cost of asset becomes nil. Next is asset acquired by way of gift or inheritance. Any asset that has been received by way of gift or inheritance. In such a case, you have received the asset for free, but there will still be some cost of acquisition, right? So the cost of acquisition for this asset will be the cost for previous owner minus depreciation allowed to previous owner. So the cost for the previous owner minus depreciation allowed, that will be your cost of acquisition. Next is a reacquisition of assets sold. Reacquisition of assets sold. In such a case, it will be WDV at the time of sale or reacquisition cost, whichever is lower. So, if you sold an asset to A for 100 rupees, if you sold it for 100, whose WDV was, say, for example, 170, then you sold this to A. A sold it to B, B sold it to C, C sold it to D, and then D sold it back to you. D sold this asset back to you, say for example, 500 rupees. In such a case, the cost of acquisition will not be 500 because you have reacquired this asset. The cost of acquisition will be WDV at the time of sale. That means your 170 or reacquisition cost, that is 500, whichever is lower. So in this case, it will be rupees 170. Okay. Next is asset purchased and leased back to the same person. Asset purchased and leased back to the same person. In such a case, the cost of asset will be the WDV of the original owner. WDV of the original owner. What does this mean? Just a second. So asset purchased and leased back to the same person. Say for example, A purchased an asset from B. Say for example for rupees 1000. Asset purchased and leased back to the same person. So A purchased an asset from B for rupees 1000, and then A gave this asset back to B on rent or on lease. So in such a case, what will be the cost of acquisition? The cost of acquisition will be the WDV of the original owner. That is, whatever was the WDV of B, this will be the cost of acquisition, not the actual transaction price. Next, building used for personal purpose, now used for business. Building was originally being used for personal purpose, but now you are using it for business. So it will be the original cost minus the notional depreciation. You have to assume that as if the building was always being used for business, so therefore you will be subtracting the notional depreciation, and then whatever amount is left, that will become your cost of asset. If there is a transfer of capital asset between holding company and 100% subsidiary company, in such a case, cost of asset will be WTV of transferor. If the transaction happened at rupees 200, assume that the capital asset was sold from holding company to 100% subsidiary companies for rupees 200, but the WTV of this asset was only rupees 50. In such a case, the cost of asset for the subsidiary company will not be 200 rupees. It will not be the transaction amount. It will be the WDV of the holding company, that is rupees 50 in this case. Okay, understood? Now, what all things are added to be cost included in cost of asset and what all things are not? So, installation charges, transportation expenses, any test run expenses, Taxes, if ITC is not available on these taxes, interest from the put to use date, all of this will be allowed to be added to your cost of asset. What has to be subtracted? Sale of trial run products. So when you did your test run, if you made any product and you sold this product, that has to be subtracted. Next, any subsidy or government grant received, this will be subtracted. Okay, and above these items that we studied in cost, we will income tax department will not allow you, income tax department will not allow you to add this to your cost if payment per person per day is greater than 10,000 through means other than account payee check, demand draft, or electronic clearing. If payment has been made from to any person per day more than 10,000 by means, any of these mentioned means, we will not allow you to add that to cost of asset. We will not give you an expense. That expense has gone. Great. Now this is the entire list of all the PGBP adjustments. Uh, So these are all consolidated on one page. We will do a separate video for this one. So I'm skipping this part for now and we'll do the other provisions. Next is your section 35. Section 35 talks about expenditure on scientific research. So expenditure on scientific research is in-house research. If there is in-house research, there is certain conditions. So only thing you have to remember is in-house research is everything is allowed. Revenue expenses, capital expenses, 100% is allowed, except one condition. So what you have to remember, before commencement of business, after commencement of business, I don't care. After commencement of business, everything is allowed 100%. That is, your revenue expenditure is allowed 100%, your capital expenditure is allowed 100%. Before commencement of business. Now, what is before commencement? How much before commencement? It says 3 years. 3 years before commencement of business is allowed. What capital expense over here also 100% deduction is allowed, but for revenue expenses before commencement of business, only salary and material is allowed. Only salary and material revenue expenses is allowed. No other revenue expenses will be allowed. Since we are allowing you 100% capital expense deduction, depreciation we will not be allowing. We are not giving you double deduction. We are just giving you 100% depreciation in 1 year itself. Capital expense does not include land because land is a non-depreciable asset. That benefit you are not going to get any which way. So why will we give you now? Therefore, capital expense does not include land. In case of contribution to research association, institute, college, university, laboratory, company, 100% deduction allowed. So first we did your in-house research. That means this expense you do on your own. This last point that we studied is when you donated, when you give your funds somewhere else, in such a case, 100% deduction will be allowed only if it is for scientific research. Next is your preliminary expenses. Preliminary expenses are the expenses that you do before getting into a business or doing your due diligence. So in such a case, these are examples. Say for example, your feasibility study report, market survey, legal fees, etc., etc. So what amount will be allowed? That is your actual expense or 5% of cost of project, whichever is lower. Actual expense or 5% of cost of project, whichever is lower. However, for Indian companies, there is an added benefit. What does the income tax say? That means instead of cost of project, if for cost of project, for Indian companies, we will give you another option that instead of just cost of project, we will give you cost of project or capital employed, whichever is higher. Cost of project or capital employed, whichever is higher, then you multiply it by 5%, then you compare it with the actual expense, and whichever is lower, that will be the deduction allowed. This is only for Indian companies. Next is your section 35 triple C. Section 35 triple C is your agriculture extension project, and section 35 CCD is your skill development project. So under this, 100% of revenue and capital expense deduction is allowed. Over here, what you have to remember, capital expense does not include land and building. Over here, only land was not included. Over here, both land and building, both of them are not included. Both of those, we will not give you 100%. We will not give you 100% deduction. You have to take depreciation on building and on land, so you will get nothing. Next is your section 35 AD, that is your specified businesses. So under section 35 AD specified businesses, there are 14 businesses that have been listed. So the government wants you to invest in these businesses. Therefore, certain benefits, certain deductions have been given to these. So, warehouse for agriculture produce or sugar, your cold chain facility, fertilizer, beekeeping and production of honey, pipeline for natural gas and petrol, slurry pipeline for iron ore, iron ore, housing project under the slum development scheme or the affordable housing, hospital with minimum 100 beds. Remember, it is 100 beds. Two-star hotels or above, two or above. Any infrastructure facility, semiconductor wafer manufacturing unit, ICD or your CFS. So these 14 businesses, if you are into any of these 14 businesses, we will give you a certain benefits. Now, what are these benefits that are under section 35 AD? So 100% capital deduction allowed. Over here also we are giving you 100% capital deduction, but we are not giving you on land. Okay, so what you have to remember, land is always there, and under that section 35 CCD etc. on that we study that building also you will not receive. Plant and machinery should be new. 20% can be old. So all your plant and machinery should be new. Only maximum 20% can be old. SB stands for your special business, specified business. So specified business loss can be set off against specified business income. What you have to see, only specified business loss can be set off against your specified business income. And this can be done for infinite period of years. That means carry forward is infinite years. All benefit claimed to be reversed if asset is not used in your specified business for a period of 8 years. So all the benefit that we've given, that will be reversed. That was your section 35 AD. Next is your section 44 AA, that is maintenance of books of accounts. So certain people, certain businesses, certain provisions are required to maintain books of account. That is under section 44 AA. So certain specified professions. Who are these professions? Interior decorator, engineer, tech consultant, accountancy, film artist, architect, legal, your CS and medical. These are some specified professions. If the gross receipts exceed 1.5 lakh in all three previous years, over here you have to see that it says all three previous years. Gross receipts have to be greater than 1.5 lakh in all three previous years. In such a case, the specified person has to maintain books of accounts. Okay, sir, what about other business? If your PGBP is greater than 1.2 lakh, so see over here the limit was 1.5 lakh, over here the limit is 1.2 lakhs. Or your gross receipts is greater than 10 lakhs. So instead of 1.5 lakh, your gross receipts is 10 lakh. So if for other business, if your PGBP income is more than 1.2 lakhs or that means either of these two, or your gross receipts is greater than 10 lakh, in any of the three previous years, over here it was all three previous years, over here it is any of the three previous years. In such a case, the person has to maintain book of account as per section 44 AA. However, for individuals and HUF, instead of 1.2 lakh, this limit will be 2.5 lakh, and instead of 10 lakh, the limit will become 25 lakh. Only for individuals and HUF, this 1.2 will become 2.5, and this 10 lakh will become 25 lakh. Okay, clear? I hope section 44 AA is clear. Next is your section 44 AB. Section 44 AB is your audit of book of accounts. So 44 AB talks about certain people are required to get their books of accounts audited. Now, of course, only and only when you maintain books of accounts will your books of accounts be audited. So therefore, the limits in this section will be much more than the limits in section 44 AA. So for businesses, if the previous year turnover is greater than 1 crore, in such a case they have to get their books of accounts audited. This star I will explain. For profession, if the gross receipts in previous year is greater than 50 lakhs, you have to get books of accounts audited. And if your 44 AD or 44 ADA, that is your presumptive taxation, next section only, if any of these SEC claim that their income is less than 6%, 8%, or 50%, in such a case, they have to get their books of accounts audited. Okay, now sir, what does this star mean? This star is a extra condition. That means if cash receipts or payments are up to 5% of total receipts or payment, that means the total receipt that the business have received or the total payment that the business has made, if cash portion out of them is up to 5%, that means 5% or less, in such a case, this instead of 1 crore, your limit will be 10 crore. Great. So instead of 1 crore, this limit will be 10 crore if your cash receipts or payments are within the 5% limit. Next is the presumptive taxation. Now you have to remember that this presumptive taxation is only for individuals and firm, and LLPs are not included, only individual and firms. So there are some presumptive taxation, basically 44 AD and 44 ADA are very important. 44 AD talks about businesses, 44 ADA talks about profession. That means if the businesses do not want to compute their income, they can directly compute their PGBP income as a certain percentage of their turnover or gross receipts. So 44 AD for businesses whose gross receipts is less than or equal to, for businesses whose gross receipts is less than or equal to 2 crore or 3 crore. Okay, this is the same star that we studied, and this is an amendment. So make sure you remember this. Over here, now the limits are 2 crore or 3 crore based on the 5% rule. PGBP income will be 8% or 6% of your gross receipts. So 8% is normally, and 6% is when 6% is for your digital transactions and 8% is for your non-digital transactions. That into your gross receipts will become your PGBP income. Similarly, for section 44 ADA that talks about your profession, your limits are 50 lakh and 75 lakh. This 75 lakh is also an amendment. That will be your 50% of your gross receipts will become your PGBP income. Remember, this is your PGBP income. You still have to calculate tax on this. This is not your tax amount. This is your PGBP income. They are not required to maintain books of accounts, and neither are they required to get them audited if they come under presumptive taxation. For section 44 AE, section 44 AE is for transporters. So which transporters are included? If the number of vehicles are less than or equal to 10 during the year, that means if at any point of the year, if you had more than 10 vehicles, even if you had 11 vehicles just for one day, in such a case, you will not be eligible to take under section 44 AE. You will not be allowed to take presumptive taxation. So your PGBP income for heavy goods vehicle will be 1000 per ton per month, and for others will be 7.5 thousand per month. Okay, so for heavy goods vehicle it is 1000 per ton per month. That means if it is a 10 truck, if it is a 10 ton truck, in such a case, it will be 10,000 per month. Therefore, 1,000 per ton per month. And for others, it is 7.5 thousand, 7,500 per month. Next is your section 44B, that is shipping, and 44BBA, that is aircraft. Now, this you have to see that this is for non-residents. So section 44 AD, 44 ADA, and 44 AE, these three sections that we studied right now, these are for residents only for resident, and these are optional, these are not mandatory. If a resident wants, he can choose these. But sections 44B and 44BBA are compulsory, and they are for non-residents. So these both sections are for my non-residents, and they are compulsory. 44B talks about shipping, that is 7.5%. 7.5% of the amount that you have received in India, plus if the destination starts in India, that means if the journey starts in India, 7.5% of this amount. And for aircraft, it is 5%. So how do you remember this? Shipping. If you see shipping, it is SHIP, 4 letters, PING, 8 letters. So about 7.5% will be the rate. And for aircraft is nothing but plane. So it is PLANE, that is your 5%. So 5% will be for aircraft. Last part of this chapter is your 44C, that is branches of foreign company head office expenses. That means if there are any foreign companies whose branches are in India, and these branches pay head office expenses to the foreign company, in such a case, how do you deal? How much expense will be allowed? So we will allow you only 5% of adjusted total income we will allow you only 5% of adjusted total income, that is any before brought forward depreciation, loss or fixed deduction. 5% of adjusted total income we will allow you, or the expense that you have attributed to HO. Whichever is lower, only that much expense will be allowed. That means maximum cap is 5% of adjusted total income. And last is your section 9B. Section 9B is your when stock in trade is transferred by firm to a partner. When if a firm is being diluted and it is being the assets are given to partner. In such a case, the fair market value of asset for the firm will be the PGBP for the firm. That will be the PGBP income for the firm. And with this, we are done with the PGBP chapter, and we will be covering the deductions and the deduction that are allowed and not allowed in a separate video. And I'll see you right there.